Nurse in Tucson did everything right. She worked 32 years. She retired at 66 with a pension, her Social Security, and a small IRA she had been adding to since her 40s. In her first year of retirement, she sold a rental property she had owned for 18 years. It was a clean transaction. The title company handled it. She got a check for $240,000. She deposited it, paid the federal capital gains tax she owed, and moved on. 14 months later, a letter arrived from Medicare. Her Part B premium was jumping from $174 a month to $491 a month. Her Part D premium nearly doubled on top of that. She called Medicare. She called her insurance agent. Nobody could explain it clearly. What happened was simple, and it was completely preventable. The sale of that rental property pushed her modified adjusted gross income above a threshold she had never heard of. And Medicare, which looks back 2 years at your tax return, saw that spike and raised her premiums accordingly. She paid an extra $3,800 in Medicare surcharges that year, on income she had already paid taxes on. Nobody warned her this existed. Her financial advisor never mentioned it. Her accountant filed the return correctly and said nothing. And the rules that would have let her challenge it and potentially reduce her premiums were sitting right there on the Social Security Administration website, unused, because she did not know to look. That retired nurse is not unusual. She is what happens when a retiree makes a perfectly legal financial decision without knowing that Medicare is watching your tax return from 2 years ago and will send you a bill with no warning, no explanation, and a 60-day deadline to fight it. Today I'm going to show you exactly how this trap works, who it hits, how to avoid it before it happens, and what to do if you are already in it. This video is for educational purposes only and is not tax or financial advice. Consult a qualified professional before making any decisions about your specific situation. My name is Frank Retires. Every day I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Here's what you need to understand first. Medicare Part B and Part D are not flat premiums for everyone. The federal government applies a surcharge to higher income retirees called IRMAA, which stands for Income-Related Monthly Adjustment Amount. Most retirees have never heard those words, and the ones who have usually think it only applies to wealthy people. It does not. It applies to anyone whose modified adjusted gross income crosses certain thresholds, even if that income came from a one-time event that will never happen again. A Roth conversion. The sale of a house. An inherited IRA distribution you were required by law to take. A year when your required minimum distributions were higher than usual because you delayed them. Any of these can push your income above the threshold for a single year. And Medicare, which uses your tax return from 2 years prior to set your premiums, will see that spike and raise your premiums for the entire following year before you ever know it happened. In 2026, the IRMAA surcharge brackets work like this. If your modified adjusted gross income in 2024 was $106,000 or less as a single filer, or $212,000 or less as a married couple filing jointly, you pay the standard Part B premium of $174.70 per month. The moment you cross $106,000 as a single filer, your Part B premium jumps to $244.60 per month. That is an extra $840 per year per person, and it keeps climbing. The second bracket starts at $133,000, the third at $167,000. By the time you reach the top bracket, above $500,000 single or $750,000 joint, you are paying $594.10 per month for Part B alone. That is $4,130 per year, more than a retiree in the bracket below you. And because Medicare applies surcharges to Part D as well, your total IRMAA hit across both programs can exceed $5,000 a year per person. A married couple can pay over $10,000 more in Medicare premiums in a single year because of one income spike 2 years earlier. Let me put real numbers on this so you understand exactly what is at stake. Take a couple, both 68 years old. He has a pension of $58,000. She receives Social Security of $22,000. They have $15,000 in dividend income from their investment account. Total modified adjusted gross income, $95,000. They are comfortably below the $106,000 threshold. Standard premiums for both. Total annual Part B premiums, about $4,190 combined. Now they decide to do a Roth conversion in October. Their financial advisor suggests converting $40,000 from a traditional IRA while the market is down. Smart move in isolation. Their income that year, $95,000 plus $40,000 equals $135,000 modified adjusted gross income. They crossed the first IRMAA bracket and they crossed into the second one. 2 years later, their combined Part B premiums jumped from $4,190 to approximately $6,940, an increase of $2,750 per year. On top of that, their Part D surcharges add several hundred more. Total surprise Medicare bill from one Roth conversion, over $3,000. They did not lose anything permanently. The Roth conversion was still worth doing at the right size, but nobody ran the Medicare math alongside the tax math. The advisor saw a lower tax bracket and optimized for that. The IRMAA bracket was invisible in the calculation. That is the trap, and here's the part that makes it worse. Medicare sends you a notice called an IRMAA determination letter. It arrives around November or December, before the year your premiums change. It tells you what your new premium will be. Most retirees do not understand what they are reading. Some put it in a drawer, some call Medicare and are told the income number came directly from the IRS. What most of them do not know is that they have 60 days from the date on that letter to file a formal appeal, and that appeal can work. Here is how to fight it. The Social Security Administration allows you to request a reduction in your IRMAA surcharge if your income drops significantly because of what they call a life-changing event. The form is SSA 44, and it is free to file. The qualifying life-changing events are marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income-producing property, loss of pension income, and employer settlement payment. Notice what is not on that list. A one-time Roth conversion is not a life-changing event under the SSA 44 definition. Neither is a property sale. Neither is a large required minimum distribution. That is the brutal reality. If your income spike was one of those, the SSA 44 will not help you. But if your income in the 2 years since that spike has returned to a normal level, you can request that Medicare use a more recent tax year instead of the standard look-back year. This is called an amended income-related monthly adjustment amount determination. You call the Social Security Administration, explain that your current income is significantly lower than the year they used, and request that they reevaluate using your most recent return. If you just filed your taxes and your income has dropped back below the threshold, this call can eliminate the surcharge entirely within the same calendar year. The retired nurse in Tucson qualified for exactly this. Her income in the year after the property sale went back to normal. She called the Social Security Administration, referenced her most recent tax return, and had her IRMAA surcharge removed mid-year. She recovered about $2,200 of what she had paid. She left money on the table because she did not make that call until 9 months into the year, but she recovered most of it. If she had known to call in January, she would have recovered all of it. Now let me walk you through the 6 situations that most commonly trigger a surprise IRMAA bill for retirees who had no idea it was coming. Situation 1. Roth conversions. As I just showed you, converting traditional IRA money to a Roth IRA is one of the most powerful strategies available to retirees in the gap years before required minimum distributions begin. But the converted amount counts as ordinary income in the year of conversion. If the conversion pushes your modified adjusted gross income above $106,000 single or $212,000 joint, you are paying the IRMAA surcharge 2 years later. The fix is not to avoid Roth conversions. The fix is to calculate your IRMAA exposure before you convert and stay below the threshold, or convert deliberately knowing the surcharge is part of the cost. Situation 2. Required minimum distribution stacking. If you delayed your first required minimum distribution to the April 1st deadline that the IRS allows, you were required to take 2 RMDs in the same calendar year. Your first year RMD for age 73 and your second year RMD for age 74 both hit your tax return in year 2. That stacking effect frequently pushes retirees over the IRMAA threshold for the first and only time in their lives. 2 years later, they get the premium increase letter with no memory of why their income was elevated. The fix is to take your first RMD in the year you turn 73, not in April of the following year. One decision eliminates the double stack entirely. Situation 3. Sale of appreciated property. The Tucson nurse's situation. When you sell a rental property, a second home, or any appreciated investment asset, the capital gain is included in your modified adjusted gross income for IRMAA purposes, even if you had 0 ordinary income above the threshold. A single real estate transaction can push a retiree with modest annual income into the highest IRMAA bracket for 1 year. The fix is timing. If you are planning a property sale and you have some flexibility on closing date, look at which tax year gives you the lower total income including the gain. Moving a December closing into January moves the gain into the following tax year, which means the IRMAA impact shifts 2 years forward. That can give you time to plan around it. Situation 4. Inherited IRA distributions. Under the Secure Act, most non-spouse beneficiaries are now required to empty an inherited IRA within 10 years. If you inherit a large IRA from a parent or sibling and take the required distributions, those amounts count as ordinary income. A $200,000 inherited IRA distributed over 10 years means $20,000 of additional income per year at minimum, and much more if you take it in a lump sum. Combined with your own retirement income, that can easily breach the IRA threshold. The fix is to spread the distributions thoughtfully across the 10-year window, taking more in years when your other income is lower. Situation 5. The capital gain from a home sale. If you sell your primary residence and your gain exceeds $250,000 as a single filer or $500,000 as a married couple, the excess gain is taxable. For retirees who have owned a home for 30 or 40 years in an appreciating market, this is increasingly common. In California and other high appreciation markets, a retiree selling a home purchased for $120,000 that is now worth $900,000 could have $430,000 in taxable gain above the exclusion. That amount will push almost any retiree into the highest IRMAA brackets. and the Medicare premium increase arrives 24 months later, like a delayed invoice from a sale they may have long forgotten about. Situation 6. Social Security lump sum payments. If you delayed claiming Social Security and then claimed retroactive benefits, you may have received a large lump sum payment covering several months of back benefits. That lump sum is included in your income for the year you received it. Combined with your regular monthly benefits and other income, it can trigger an IRMAA surcharge 2 years later. The IRS does allow you to elect to treat the lump sum as if it had been received in the prior years through a special tax calculation, which can reduce the impact on your modified adjusted gross income. Ask your tax preparer specifically about the lump sum election before you file the year you receive it. Now, before I get to the checklist, I need to tell you about a protection that exists that almost no retiree knows about. When wealthy people do estate and tax planning, their advisor runs IRMAA projections alongside every major financial decision. Every Roth conversion is sized to stay under the bracket. Every property sale is timed with Medicare in mind. Every RMD is modeled 2 years forward. For most retirees, nobody ever ran that calculation. Not the accountant, not the financial planner, not Medicare, not the Social Security Administration. You are supposed to know this on your own. The official name for the appeal process is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Request, and it lives at ssa.gov. Most retirees who qualify never file it. Not because they chose not to, because they did not know it existed until after the 60-day appeal window on their determination letter had already closed. If you received an IRMAA determination letter in the last 60 days, stop this video, go to ssa.gov, and download Form SSA 44 immediately. If your income has dropped since the look-back year, you may be able to reduce your surcharge before the year begins. That form has a deadline and Medicare does not extend it for ignorance. Here is your action checklist. 6 things to do this week. 1. Calculate your modified adjusted gross income for this year and compare it to the IRMAA thresholds. Single, $106,000. Married filing jointly, $212,000. If you are close to either threshold, any large one-time income event this year will cost you in Medicare premiums in 2028. 2. If you are planning a Roth conversion this year, run the IRMAA math before you convert. Determine exactly how much you can convert before crossing the next bracket. Converting to the bracket ceiling rather than past it can save you over $1,000 per year per person in Medicare premiums. 3. If you have a required minimum distribution due this year and you turn 73, take it before December 31st. Do not delay until April 1st of next year. Taking 2 RMDs in the same year stacks your income and is one of the most common unintentional IRMAA triggers. 4. If you are planning a property sale this year, ask your tax professional to model the IRMAA impact of closing in December versus January. A 1-month timing shift can move the capital gain into a different tax year and delay or eliminate the Medicare surcharge entirely. 5. If you have already received an IRMAA determination letter for 2026 or 2027 and your income has since dropped significantly, call the Social Security Administration and ask about filing Form SSA 44 or requesting an updated income determination using a more recent tax return. Do this before the 60-day window on the letter closes. 6. If your income spike was a one-time event and you are back to normal income levels, call the Social Security Administration in January of the surcharge year and request a new income determination using your most recently filed tax return. This is the call that recovers money most retirees never know to make. The IRMAA trap does not punish bad decisions. It punishes good ones made without full information. Selling an appreciated property, doing a Roth conversion, taking required distributions, collecting Social Security, every one of these is correct retiree behavior. The trap is that each one carries a Medicare price tag that arrives 2 years later, addressed to someone who cannot remember why their income was elevated or what they could have done differently. The retirees who avoid it are not the ones who earn less. They are the ones who ran the 2-year Medicare math before they signed anything. This is Frank Retires. If this video helped you, hit the like button right now. It takes 1 second and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know a retiree who sold a property, did a Roth conversion, or is just entering Medicare, send them this video today. Not tomorrow, today. Drop a comment. Did you know IRMAA used your tax return from 2 years ago? Have you ever received a surprise Medicare premium increase? I read every single one, and the most common situations become future videos. I will see you in the next one.